you thinking about the tariffs increasing, and then also if another round of tariffs go into effect?
So that's the big risk factor, of course, is around the tariffs. So the current tariffs, which are now up to 25%, a lot of those items are excluded from the consumer basket. They're more of the intermediate goods. So they're not going to hit the end consumer in a really direct way. But if you get the expansion to all of Chinese imports, then you're talking about the consumer that's going to be directly impacted. And that's going to essentially be like a tax to the consumer. And I think you will certainly see an impact in real spending on the back of that.
How much does it impact your GDP forecast if they all come in as much as touted?
Yeah, so, you can look at the direct and then you have to think about the indirect linkages. So on the direct side, if all of those will go in, it's about a 0.3 to 0.4 hit to GDP growth. But then if you have a deterioration in financial conditions, if you have a deterioration in confidence, both business confidence and consumer confidence, you're talking about potentially a much bigger drag. So that's where I think the risk factors lie is what's the perception out there around these trade wars? Mm-hmm. How much do consumers cut back in the faces? How much do businesses get worried and cut back? You're already seeing that in a lot of the survey data, and it could just get worse if this trade war continues.
Michelle, the president yesterday wants the Federal Reserve to match, using his word, Chinese stimulus into the economy.
Yeah.
There's two separate issues here, and we need to separate them. One is this idea of the president sort of urging the central bank to do policy. The other, though, it makes some economic sense, right? If we play this through, China stimulates its economy, lowers interest rates. That should depreciate the yuan and relatively strengthen the dollar. Should that be a cause for the Federal Reserve to move? It's not a crazy idea, right?
Well, it comes back to this idea of kind of this little mini currency war that we've been seeing now for the past several years. So in that respect, no, you have to think about financial conditions broadly, and one of those financial conditions is the dollar. So if the dollar is strengthening a lot, that's a tightening of financial conditions, and that's a headwind to the economy. And in theory, you could argue that can be a reason for the Fed to consider cutting interest rates. But I think the Fed needs to be very careful right now in terms of how they respond to this trade war and these tariffs. Because if it's a temporary trade war, if it's tariffs that go into place and then are taken away, it's not necessarily appropriate for the Fed to change the course of policy. But if they think it's something that's more permanent and it's going to have a lasting impact on the economy, then I think the Fed has to think about these downside risks and how they want to get ahead of it and they want to preempt those
Mike,
risks.
But they can reverse their policies quickly as the tariffs can be reversed.
Sure, but that hurts exactly. It hurts their credibility to do that. So if they cut on the back of what they think is going to be a hit to the economy from tariffs, then tariffs go away. They can't say, oh, oops, we're gonna hike. We're gonna take that back. It's a little bit hard for them to do.